Hey everyone, welcome to This Explainer. I'm Zed, your resident finance zombie host, and we are about to kick off the ultimate brain-saving cram session. If you're prepping for the FRM exam, consider this your essential survival guide for navigating the incredibly dangerous landscape of financial markets and products. We're going to lock in the absolute must-know concepts, and we're going to do it efficiently, visually, and structurally. To survive today's explainer, we're going to navigate 4 main quarantine zones. We've got institutional survival, demystifying derivatives, central clearing safe zones, and fixed income weapons. Let's get to it. Zone 1, institutional survival. Okay, high alert here. Banks are swarming with hazards, and you've got to be able to spot the 3 main infections right away. First up, credit risk. This is just the danger that borrowers don't pay up or counterparties default. Then, market risk. This hits the trading book when securities tank because of interest rates or stock shifts. And finally, operational risk. Think cyber attacks from the outside or internal stuff falling apart, like massive IT crashes or just plain old human error. Now, what's really interesting about this slide is how we look at the antidote, capital. See, banks like to self-medicate, right? They use economic capital, which is just the amount they think they need based on their own internal risk models. But regulators, they don't exactly trust that self-assessment, so they force them to hold regulatory capital. These are standard minimums set by the Basel Committee. And honestly, Basel has gotten way stricter lately. They've put in a floor, meaning a bank's internal models can't spit out a capital requirement that drops below 72.5% of the standardized approach. They gotta pad those reserves. All right, pivoting away from banks, let's talk about life insurance. These guys survive by predicting mortality risk. It's kind of like a lifeline. Look at how these curves cross. Early on in a policy, the premium you pay is way higher than the expected cost to the insurer, right? That builds an expected surplus. But as we age, well, mortality risk goes way up, leading to an expected deficit. The whole survival game for life insurers is investing that early surplus safely enough to cover the massive payouts later. And because human lifespans are pretty predictable statistically, this model is incredibly stable. Now, property and casualty, or P&C insurance, totally different beast. P&C doesn't have that smooth, predictable curve. They deal with sudden, catastrophic losses. Hurricanes, huge liability claims, you name it. So you absolutely have to memorize this P&C survival formula table for the exam. The combined ratio? It's literally just your loss ratio plus your expense ratio. Simple. But if you want the operating ratio, you take that combined ratio, adjust for any dividends, and then subtract your investment income. These numbers are crucial. They tell you in a heartbeat if an insurer is bleeding out from unexpected disasters. Moving on to pension plans. You've got to nail this distinction for the exam. Who actually bears the risk when things go south? With a defined benefit plan, the payout is locked in. It's explicit. So the employer takes on all the investment risk. If the fund comes up short, the employer has to write the check to cover it. But with a defined contribution plan, the employer just chips in a set amount to an account. If the market totally tanks, well, it's your retirement fund that shrinks. The employee is the one bearing 100% of that risk. Okay, let's look at the absolute apex predators of the fund world, hedge funds. These guys cater to wealthy investors, they dodge standard mutual fund rules, they use a ton of leverage, and they lock up your money so you can't just pull it out whenever. But the craziest part is how they take a serious bite of your brains, your returns, with the classic 2 and 20 fee structure. That is a flat 2% management fee on all your assets, just for showing up, plus a massive 20% cut of the profits generated above a certain benchmark. And to earn those massive incentive fees, they get really aggressive. Let's quickly run through their tactics. Long slash your equity, they buy undervalued stocks and short overvalued ones to hedge sector risk. Dedicated short funds, they're literally hunting for weak companies to bet against. Distressed debt is wild. They buy deeply discounted bonds of failing companies, sometimes buying enough to actually block the company's reorganization plans. Then you have merger arbitrage, betting on the price gaps during acquisitions. And global macro, making gigantic, highly leveraged bets on entire currencies or global interest rates. Zone 2, demystifying derivatives. Okay, let's dive into this. Derivatives are basically tools. They can be your antidote, hedging against infection, or they can create insanely massive speculative leverage. Let's draw a hard line between forwards and futures. Forward contracts are OTC, over-the-counter. They're totally private, custom-built agreements between 2 people. But man, they carry huge counterparty risk. If the other guy goes under, you're out of luck. Futures, though, they trade on public exchanges, they are super standardized, they settle up daily, what we call mark-to-market, and because of that, they have basically zero bilateral counterparty risk. Now, forwards and futures lock you in, right? There's zero-sum linear obligations. Options are a whole different story. An option is a contract that gives you the right, but definitely not the obligation, to buy or sell an asset at a set price. It's literally just like paying for an insurance premium. You pay that upfront premium, and it completely protects your downside if things get ugly, but it leaves your upside totally open for survival. It's that asymmetrical payoff that makes options such a unique lifesaver.
Zone 3. Central Clearing Safe Zones.
All right, welcome to the ultimate market shelter, the Central Counterparty, or CCP. Here's their exact rescue protocol for stepping into a messy OTC market. Step 1, trade acceptance. Two parties agree on a trade and hand it over. Step 2, novation. This is key. The CCP legally steps right in the middle. They become the buyer to every seller and the seller to every buyer. That original bilateral contract? Poof, it ceases to exist. And step 3 is netting, where they smash all those redundant overlapping positions together into one single clean payment. And this brilliantly illustrates the sheer power of multilateral netting. Look at the left side. No netting. It is a chaotic, tangled web of bilateral risk between entities X, Y, and Z. If one of them trips up, the infection spreads everywhere. But on the right, by interjecting itself, the CCP turns that entire contagious mess into simple, safe, zero-sum lines. Entity X just owes the CCP. Boom. The contagion is stopped completely dead in its tracks. Of course, the CCP has to protect itself, right? So they force everyone through 2 strict margin checkpoints. First is initial margin. This is your upfront collateral, and it's calculated based on how risky that specific transaction is, usually built to cover a 99% confidence interval of what could go wrong. Then you have variation margin. This is the daily mark-to-market cash transfer. If your position drops in value today, you are paying out that variation margin today. It's absolutely crucial because it guarantees nobody is secretly running out of cash halfway through a trade. Zone 4, fixed income weapons. Here we are, the final and most dangerous zone. We're talking interest rates and defending your bond portfolio. Your absolute first line of defense against shifting yield curves is duration. Let's look at the modified duration formula. You take the Macaulay duration and divide it by 1 plus the yield over your compounding frequency. Basically, it estimates the percentage your bond's price will change if yields shift. But, and this is a massive warning, duration assumes a flawed, straight-line, linear relationship between price and yield, and when rate changes get big, that straight-line assumption totally breaks down. So, the crucial point is this. Bond prices don't move in a straight line, they curve. When rate shifts are massive, duration fails. It's just too linear. That's when the convexity effect steps in to save your portfolio. Convexity measures the actual curvature of that price path. And here's a pro tip for the exam. For option-free bonds, the convexity effect is always positive. That means it acts like a cushion. It shrinks the price drop when yields spike, and it boosts your gains when yields fall. To survive the exam and the actual market, you literally have to combine both of these mathematical weapons. Look at the ultimate survival formula here. The estimated percentage change in a bond's price is approximately equal to the duration effect plus the convexity effect. Duration gives you that initial straight line estimate, and convexity comes in and adds the exact curvature correction. Put them together and you've got a near-perfect estimate of how your bond's price will react to major yield swings. Which brings us to the final hurdle of our cram session. I'm going to leave you with a do-or-die question to test your survival readiness. What happens to a duration-based hedging strategy when yield curve shifts are large but also non-parallel? Think about it. The answer? The hedge breaks completely. See, duration assumes parallel shifts, that all yields move perfectly together. If short-term rates spike while long-term rates drop, your simple duration hedge is going to fail miserably. Understanding limitations like that is exactly what separates the survivors from the casualties. Keep studying, trust the structure, and I'll catch you in the next explainer.